Hello, everybody. Welcome to this episode of the Weekly Wrap. This is episode 17, and this is actually going to be a mix between our daily dose for Monday and the Weekly Wrap. So I just want to say, if you like this type of content, please subscribe on YouTube and follow us wherever you listen to podcasts. I do apologize for the Weekly Wrap episode being a little bit delayed, but I'm just going to combine it with what we usually do in the daily dose. So in the beginning, I'll go through today's article like we do on the Daily Dose. Then I'll go through the Weekly Wrap where we go through some charts and thoughts about just some more general things. And then I'll get into the S&P 500 and Bitcoin and all that at the end. So let's start with today's news. So we started the week higher today as midterms in the CPI report loomed this week. So U.S. stocks pushed forward Monday as investors geared up for another week of potentially market-moving events. The November 8th midterm elections, that's tomorrow, and the October consumer price data. The S&P 500 rallied 1%, while the Dow Jones Industrial Average jumped more than 400 points, or roughly 1.3%, and the Nasdaq was up 0.9%. A batch of downbeat corporate news has renewed focus on the wreck across technology stocks after disappointing earnings last week dragged the sector's heaviest hitters. Apple was down despite beating on their earnings. Amazon was down a lot after missing on their earnings. Alphabet was down after missing on their earnings as well. Apple reversed a loss of more than 1% to close higher after the company said in a statement Sunday it expects fewer shipments of its newest premium iPhones than previously anticipated, citing COVID lockdowns in China that dented operations at its biggest smartphone maker, Foxconn's factory. Also among tech giants, Facebook parent Meta, which is now the worst performer in the S&P 500 index this year, is expected to begin large-scale layoffs this week, according to a report from the Wall Street Journal on Sunday. Shares rose 6.5%. Elsewhere in markets, Carvana shares sank nearly 16% after analysts at Morgan Stanley last week said the car retailer could be worth as little as $1. Election day may keep investors on edge as dozens of key races determine which political party has control over the congressional agenda. Wall Street has historically preferred a split Congress or White House, with gridlock making it difficult to execute any potentially unfavorable legislation. Quote, going back to 1929 and excluding the Great Depression, some of the best annual returns for the S&P 500 have been seen when the sitting president does not have full control over both sides of Congress, unquote. And that came from Verdant's Capital Advisors CIO Megan Horniman. And CEO Leo Kelly said in emailed commentary, quote, this may be because markets do not expect major changes to the law with a split Congress. While political campaigns have placed fiscal leadership into the spotlight, some strategists argue that midterm outcomes rarely influence financial markets outside of short-term volatility. Quote, the markets are influenced more by expected financial conditions and economic catalysts than by midterm elections, unquote. Morningstar chief U.S. market strategist Dave Sekera said in a recent note, quote, historically, some analysis has shown that equity markets have tended to underperform in the run-up to midterms and then outperform after, unquote. October's consumer price index is coming out on Thursday. However, it is sure to sway equity markets. Another hot inflation reading may solidify expectations that the Federal Reserve will raise its interest rate more than the initial forecast. And I will say that if this comes in and it's still rising or there's no signs of it coming down, that's not a good sign at all for our economy and as far as the Fed having to tighten even more, which is dangerous in of itself. Economists surveyed by Bloomberg see headline CPI at an annual 7.9% for the month, a moderation from September's year-over-year increase of 8.2%. Core CPI, which strips out the volatile food and energy components of the measure, is projected to come in at 6.5%, little changed from 6.6% last month. And we'll take a chart that looks at this more directly here in a little bit, but you might be surprised at how that's trending. Headline inflation has likely peaked, but core inflation hit its post-pandemic high just last month. While the Fed has hinted that they see reasons to slow their pace, the rate of inflation, even if it has peaked, remains far too high for comfort. Until the Fed signals the pivot is near, things could remain challenging. Okay, let's get into the main piece of our weekly wrap, and it's just going to be an update on this market. It seems to be extremely volatile and shifting even by the day. So what I want to start with is interest rates. So before the last FOMC meeting, this was our target for the forward curve, and we expected for interest rates to top out around 5%. After this last FOMC meeting, we're now having the probability that we're probably going to go above 5%, at least for some time, as we continue to fight inflation. So basically, Jerome Powell said that he's going to most likely slow down the rate at which they're hiking interest rates, but it's going to most likely be higher as far as a peak interest rate, and it might have to stay there for a little bit longer than what we were originally expecting. So this is what the market had priced in before, and now we're expected to go higher, maybe for longer. And I don't think that the market has completely priced in that reality just yet. And hopefully the CPI that's going to come out this week starts showing that this is working. And maybe they won't have to be that aggressive. But if it's not good data and inflation is sticking around, then this could keep getting higher and higher and higher because they have to get inflation under control. They have to. It's one of their mandates, but we're also just already facing a currency debasement that's unsustainable, and we're in trouble if they can't get this under control. But we're also in trouble if they keep hiking this fast, because eventually something will break. This is overly aggressive, and I understand that they have to do it. They have to get inflation under control, but it's a balance, and it's a tough job for the Fed. Everybody likes to give their 2 cents on what the Fed should do, but at the end of the day, they have a tough job, and they're not in an easy time right now. They haven't been dealt a good hand, and all we can do is hope that they make the right decisions. But yeah, right now it's looking like they're going to have to continue to be more hawkish unless we get an unexpected decline in the CPI this week. So let's talk about the CPI. So while regular CPI started to decrease just a little bit, honestly, not even by a lot. It was still over 8% last month, which is just absolutely horrendous. But core CPI actually rose. So inflation has showed no signs of slowing down. It's even showed signs of maybe even increasing. I know the expectations are for this month that it'll drop, but until we see that, it's still looking pretty bad from an inflation perspective. This is a number that will take years to come down. We're not going to get back down to the 2% target until 2024, in my opinion, at best. And even then, it could still be 3, 4, 5%. So, I mean, not only is that not good for markets from the standpoint of the Fed's going to have to be tighter, and that's just not good for equities in of itself, but also our currency is just debasing at such a rapid pace that it's not good for households. It's not good for the working class. It's especially not good for people that don't own assets, because then your money's just decreasing in value and there's nowhere for you to make up for it. That's why it's so important for you to buy stocks, real estate, commodities, all that stuff. Protect your buying power and protect your wealth, because If all you have are dollars, then this is just 8.2% eating away at your money at an 8.2% rate year over year. That's horrible. You can't live like that. So you need to protect yourself by owning assets. And even if you own stocks, your stocks are going down. Commodity, everything's going down right now. Real estate. And so what's the best thing to do in that scenario is to buy assets at good prices, because over a long period of time, they will appreciate. And over a long period of time, the value of money will depreciate. So you would rather put your money into something that's appreciating rather than depreciating. So it's really that simple. US dollars are going to depreciate year over year for every year as long as we have US dollars. And assets like commodities, Bitcoin, stocks, bonds, real estate, those will appreciate year after year. So you can make the decision on what you want to own. But for me, I want nothing to do with US dollars. Absolutely nothing to do with it. So let's talk about unemployment. We're going to start talking about signs of a recession. And first off, we're going to talk about unemployment for two reasons. One, because it can be a sign of recession, but two, because the Fed has a dual mandate, and that's to keep stable prices / inflation at the 2% target, which they're not doing right now. They're trying to get that under control. But the other is unemployment, keep it low. And right now it's low, but we've seen a slight uptick. Nothing to cause any kind of concern whatsoever, but noteworthy. Inflation is rising slightly. Month over month, we went from 3.5% to 3.7%. So nothing to really look at and be like, oh, the Fed, they need to relax because unemployment's getting too high. Maybe it's time for them to start cutting rates. We're not anywhere near there yet, but it has been falling pretty much since the pandemic, and we've seen a little uptick now. So it's something to keep in the back of your mind, because if it keeps going up, the Fed's really going to have a tough decision to make. As well as us just going into recession, this was basically the main reason that they're unwilling to call that we're in a recession, even though we had 2 back-to-back quarters of negative real GDP growth. They said that the job market was too strong, and so we're not in a recession. And so that's why you don't see this right here, because that would indicate that we're in a recession. But I just wanted to talk about this so that people understand that there is a slight uptick in unemployment. So this is really the main problem right now with the market. So let me just start off by saying this. The multiples on the S&P 500 are dropping. What's that mean? People are not willing to pay the same price for each dollar of earnings that companies are earning, because the macro environment is becoming more negative for future growth. So people don't want to pay $20, $25 for $1 in earnings. They're paying more like $14, $15 for $1 in future earnings, and all that is the PDE ratio. So it's going back to our historical average of 14 or 15, but it's still based on earnings projections that are higher than what we are actually getting in earnings right now. So if the market's going to keep pricing equity at 14 to 15 times earnings, or if we go into a really bad recession, it goes more to 10, 11, 12 times earnings, and earnings are going down at the same time, then that's when you see a rapid sell-off in markets, because multiples are dropping on the market and earnings are dropping at the same time. So you just see this rapid recession as far as equity prices go. And we're kind of teetering on that right now. 62% beat rate on earnings is pretty bad. Usually you want to see it over 70% in a strong market. Right now we're at 62% for this current Q3 22 earnings. So if we keep seeing earnings fall off and we see the market continually compressing valuations, then you'll see stock prices, go down at a rapid pace. And that's something you have to be careful about, because you might think something's at a good price right now, but if the earnings are going down and the market is compressing the multiples at which they're pricing equities, then you get that compound effect as far as sell-offs go. I hope that made sense. If not, send me an email. It's in the description of my YouTube channel, and it should be on the podcast as well, and I would be happy to explain it further. So leading indicators of a recession. Are we already here? So what this chart shows are leading indicators of things that come before a recession. So the inverted yield curve, corporate profits, unemployment, housing prices, other economic indexes. And then on the bottom here, it gives you the months until a recession is usually officially called. I will say that stocks usually bottom around the time that the recession is actually called. And that's because the market is a forward-looking mechanism. They usually call a recession late. So the market's bottoming, they're calling a recession, and then we're coming out of it around the same time. Usually that's how it goes. So the inverted yield curve is what I want to talk about first, because we've seen that now for about a year or so, and that's usually 15.7 months before a recession. So that would say that we're around a quarter before that they'll officially call a recession. Corporate profits declining from the peak. We've seen that over the last several quarters. Unemployment starts to uptick, and we brought that up today, that it is just barely starting to uptick now. Not enough for us to say that this is happening and that unemployment is becoming a problem, but it's rising slightly the last month. And then housing. So this is already happening. Wells Fargo said that they're seeing up to 90% decline in mortgages being opened. And that's not good for the housing market. So we're starting to see all these indicators. And not only does that mean that a recession will probably be called soon in the next quarter to year, but it also means that stocks will probably bottom in that same time period, if not a little bit after. So it doesn't mean that stocks are going to bottom before they call a recession, or right when they call a recession that's the bottom, but it means that historically speaking, the bottom of the market occurs somewhere in that time frame or shortly after. That doesn't mean that we still can't see a big sell-off or capitulation event where stocks drop another 20-30%. We definitely can still see that before this happens, but it's good to be aware of these different indicators, because they're usually leading indicators of a recession, not lagging ones, like inflation, which is what the Fed uses for their policy decision making. So this is kind of just like a visualization of what I said. The red X's are market bottoms and the gray shaded areas are recessions. So you see that the market will bottom during a recession after it has already been called. And you'll see that sometimes it happens in the beginning. So in 53, 58, 60, 70. This looks like 80. This looks like 90. 2001, 2020. All of those recessions, yes, there are some where it happens more in the middle or near the end of the recession, but the main point is that it happens after the recession has already been called, and before we're actually out of the recession is when stocks bottom, and oftentimes shortly after the recession has been called. And like I said, that's usually due to the fact that the market is a forward-looking mechanism, and by the time a recession's been called, we're already kind of working our way out of it. So that's the reason it looks like that. But you'll notice that a recession hasn't even been called yet. So the likelihood that we've hit a market bottom, it's not zero, but it's low. And the likelihood would be that there's still more pain to come. So let's look at this, because this is an interesting chart, I thought. And it's the 2022 NASDAQ overlaid with the 1972-73 Dow Jones. I don't know why Bloomberg or Bank of America wanted to make this comparison, but it's an interesting one. And mainly the point is that we had an initial sell-off over the course of about a year, which has happened right now. And then we traded sideways. So maybe people thought that we were bottoming, that maybe we were just kind of gathering ourselves. But then there was that big sell-off where stocks went down another 20-30%. And then we bottomed and then came out of it. And so the reason I included this chart in this episode was because it kind of goes along with what I was saying. So say a recession is called. We're in this little sideways action here. And then we fall and we're in a recession. We bottom, we come out of the recession, stocks have already bottomed, we work our way out of it, and stocks are moving into an uptrend again. So it kind of goes along with what I was saying as far as we probably haven't seen a bottom. We probably won't until a recession is officially called. The likelihood is that we will have a recession officially called, especially if the Fed keeps raising rates, because it's creating circumstances that are unsustainable. I mean, already you're seeing a large portion of small businesses unable to pay rent, unable to pay their energy bills, households savings rates at 3% after being at 30% during COVID. People don't have money, they're going into debt, they can't pay their rent. This is unsustainable. You can't have an economic system and people can't pay rent. Businesses can't pay rent. People are going into debt. I mean, eventually something's going to break. And you can't keep it like that. So odds are let me back up. I think we're already in a recession. I think we have been for the last several months, 6+ months. But they won't officially call it until unemployment is high and we're in a crisis. So the likelihood is that still will happen, despite nothing really breaking yet and rates rapidly rising. The effects will already starting to be felt, but will really be seen in the data in the coming months and quarters. And by that time, it's almost too late, and they have to flip and rush the other way. And that's what the Fed's been doing for the last few decades, is tightening too much, easing too much, tightening too much, easing too much, and it just gets more and more volatile and extreme. And to me, that's not sustainable over a long period of time either. And eventually something will break severely. Because there's been too much quantitative easing and too much quantitative tightening. The Fed's been doing too much. They have to keep fixing their mistakes, and it just keeps getting worse and worse and worse, and it's this worse and worse cycle. But that's a long way of saying that we definitely could still see some more pain in stocks and other assets for sure. So I want to talk about presidential cycles now. So midterms, this chart on the left, let's look at that first. So U.S. stocks enter historically their strongest time into the 16-quarter presidential cycle after the midterm. So you see year 3, Q1, and even year 2, Q4. So what we're entering in right now, they typically outperform pretty heavily compared to underperforming in the initial first 2 years of a presidential cycle. And then they'll usually perform better in the last 2 years than they do in the first 2 years, but they'll have that great outperformance in the 2 to 3 quarter period that we're entering in right now. That's typical midterm cycle. Now, here's the conditional seasonality of the market. So in the bull market, you'll see this during a midterm year. That's the green line. Typical your typical midterm year overlaid with a bull market. And so you'll see typically around 15-16% gains that year. That's the green line. All other years, you get your average 10%, whatever. That's your average year. Now, this is a bear market in a midterm year, and you actually see underperformance in a bear market in a midterm year in these quarters. So yeah, the market typically outperforms the fourth quarter of the second year through the second quarter of the third year in a typical midterm cycle. But when you're going through a midterm cycle during a bear market, you actually just see continued underperformance. And we actually did get this little rally in October going into November. So even that has stayed consistent with this market. So last thing I want to look at are the changing market dynamics that we've gotten through this bear market. And one of the things that's been happening more recently is the biggest market cap stocks are losing their relative weight. So they're actually dropping a lot more than the rest of the market. That would be companies like Meta, Apple, Amazon, Microsoft, Alphabet. And really this is driven by Meta and even Amazon as of late. But Meta is really a business that's hurting. The rest of the stocks are hurting, but the business at Meta is really, really hurting. And that's been driving this chart lower. But it can be a good thing when you don't have a ton of weight in an index just lumped up in these couple companies, because then the whole index, the whole market is susceptible to these couple tech companies having a bad quarter or a bad couple quarters. And so that can be a good thing. Also, in huge bear markets or tough economic times, you typically come out on the other side with a changing top 10 as far as stocks go in the indices. A couple years ago, I was watching the Berkshire Hathaway annual meeting, and Warren Buffett threw up a great chart, and it was the top 10 stocks in like 1980, and he overlaid that with the top 10 stocks in 2020. And basically, his point was that most stocks don't stay at the top for decades. They get there and they kind of plateau, and then they fall off, and then they're passed by other companies. Now, I know that companies like Apple and Microsoft and Alphabet are different in the fact that they have such gigantic moats, and they can enter any kind of business they want and put other businesses out of business. So maybe they could stay in the top 10 for longer than historical companies that are kind of just one-dimensional, and then the world changes. These companies have the ability to change with the world and keep their moats at the same time. And that's very powerful. But you see a business like Meta that's just kind of flailing around, and yeah, that could be one that could fall. It could be the poster child for this bear market. But I still do believe that Amazon, despite the stock hurting in this market, they'll recover, and they're still a phenomenal business. And Apple, Microsoft, and Google, well, Alphabet, Google has suffered, not as much as Amazon and Meta, but their stock has suffered, but still a phenomenal business. And then you have your safe havens in Microsoft and Apple, where those have a more predictable drawdown and are just such great businesses that you'll know that they'll recover, as long as there's not just this huge black swan event that wipes them out, that the probability of that happening is so low that it's not even worthwhile thinking about, honestly. So that's my little spiel about these companies. A lot of swirling opinions about them, but that's just what I think. So I also want to talk about volatility and some different asset classes, because this was a really interesting data point that ARK Invest put out this week. And the volatility in the Bitcoin market, so Bitcoin volatility, is actually lower than both the S&P 500 volatility and the NASDAQ volatility. So right now, the NASDAQ and the S&P 500 are more volatile than Bitcoin, which is kind of like a crazy stat, but I should probably say that the drawdown from the top to the bottom is higher in Bitcoin than those two indices right now. And Bitcoin's just kind of been trading in a range for the last 5 or so months, so that's why the volatility isn't that high right now. But all other times that the volatility in Bitcoin has been below the indices, it has gone on these just huge runs. The last time that Bitcoin volatility was below S&P 500 volatility for 30 days. Sorry, I should have said that, 30-day volatility. It went from $9,000 to $69,000 in less than 1 year. That's not to say that we're at the bottom of the Bitcoin market, but it could be an indicator that maybe we're getting close, and that maybe this is a good time to get in to Bitcoin or start to build a base in Bitcoin. All other times it's been this low, that's been the case. So I do want to get into the charts right now. So let's go ahead and do that. So let's get into the charts. This is the S&P 500. You can see that we're kind of in this little range between the 3,900 and the 3,650. Basically, we sold off of this zone before the FOMC meeting. We sold off to almost our level right here, and then now we've started buying up a little bit. We could reach back up to the 3,900, but we don't have to. I think that we are seeing a little bit of a bullish trend here as far as just a higher low, and maybe we'll see a higher high, but we'll have to see some more strength to confirm that. Where could it go to the upside? Well, obviously, this is our first level where we'd see some selling pressure around the 3890 to 3900, and then around the 3975 is where you could expect some more. And then in the event that we make it through there, obviously the 200-day moving average would be a huge level of resistance. And I would be really surprised if we made it up there in the first place, but I would just be shocked if we broke through that right now. So that's what I'm looking at to the upside. Not really a ton of space. I mean, I know the 4100, that's a pretty good percent chunk up, but there's a lot of levels where selling could become a factor before we get there. And then obviously to the downside, I think if we see another leg down, I'm eyeing that 3250 still. And I think that makes a lot of sense for the S&P 500. Let's get into Bitcoin last but not least. So Bitcoin almost has been looking like it's been leading the stock market. So it pushed higher before the market really started to rally. It hit our top, like literally the top of the zone. Look at that. It closed right where we have our zone, the 21,289. Like that's crazy. But it's been selling off now. So the market rallied. We sold off still in Bitcoin. And we're still stuck in this low range. So we're stuck between the 2440 and the 21, call it 300. And we're just in that range right now. So Bitcoin's been in this larger range for months and months and months. And the next move will be big out of Bitcoin here. So that's really all I had today. I know that the Daily Dose episodes are usually short, but I wanted to still put out a weekly wrap episode and kind of merge it with our daily videos. So thank you for sticking around and listening or watching to this episode. Please remember to subscribe on YouTube and follow wherever you listen to podcasts. And until next time, thank you for listening.